Hello and welcome. We're joining us live for the Investor Lab. And Gabby, I'm not sure if you heard me. I think I got the timing right that time, but my voice gave out.
You nailed it.
I don't know, but my voice gave out on the high note there.
That's okay. We're like 99% there.
99% there. Hello and welcome. Thanks for joining us live again today, this Friday, for the Investor Lab. My name is Goose. We've got Gabby here as well. Hello, Gabby.
Hello, Goose.
And we are joined by the Prince of Property, Sean Simpson.
I love it.
I forgot about that. Excited to be back. Excited to give everyone a break from listening to Callum every Friday. So good to be here.
But it almost sounds like you're a little bit jealous about the.
I know.
A little bit. I mean, he's the Prince of Finance. You'll have to start that.
Yeah, you'll have to come up with something. So, guys, let us know if you're joining us here live. We're always excited to see you here. There's lots of great engagement, lots of great interaction last time. Very excited for the topic today. You may notice that I have a slightly different haircut today, but I also am a little bit ill. So if I sound funny and look funny, those are the reasons. I look funny because I got a haircut, and I sound funny because I'm a little bit sick. So
I like the haircut. Guys, throw compliments at him.
No, I don't throw compliments at me. I really don't like it. I really don't like that. No, don't. Let's not encourage that kind of behavior. Neutral Rockets. One day we'd love to know your actual name. Nice to see you. Hitesh, great to see you. How are you, Hitesh? Nice to see you. Afternoon, Matthew. Yes. Great to see you. Last week was very informative. Good stuff. Brendan Chapman, loving to hear. Thank you very much. Thank you very much. Appreciate it. Good to see you, Brendan. Great to see everyone here. One moment.
Oh. Sean, how are you? How are you doing?
I'm doing great. I'm excited to be here. I'm doing great.
Perfect.
Good. This is going to be an interesting episode.
No haircut.
This is going to be an interesting episode. Peter, yeah, it is a very efficient haircut. It helps the weights move faster.
Aerodynamic.
Yeah, that helps me with my bodybuilding. All right, guys, let's get stuck into it. I'm very excited for today's episode. We're going to be tackling a very interesting topic, and we're going to kind of duck and weave around a few ideas here. But kind of part of the core premise that we want to tackle is that not all growth is created equal. Now, at some point, growth is growth, right? At some point, if you're making money, you're making money, but not all growth is created equal. Now, the reason we want to talk about this is when we started Dashdot, or the kind of, let me separate two ideas here. The Investor Lab is not Dashdot, but necessarily Gabby and I own Dashdot. Sean is head of property at Dashdot. So there is a relationship there between these two ideas. Mm-hmm. Dashdot's purpose is to empower everyday Australians to make informed, intelligent investment decisions so they can live more prosperous, more confident, and more fulfilling lives. And so when we see things happening in the market that cause us concern, we feel like we have an obligation to discuss these ideas as well, to try and make sure that people out there, whether or not they're working with Dashdot, doesn't really matter, can make informed, intelligent decisions so they can live more confident, more prosperous, and more fulfilling lives. Now, going back to when we very first started Dashdot, I just sort of want to tell a little bit of a story here because I think it's relevant to where we're at today. And some of you may have heard this story before, but back in 2019, when Gabby and I started Dashdot, we got our very first client. I'm not going to mention his name. But we got our very first client, and he's still a client today. And we've bought several properties with him, and it's been an amazing and wonderful journey for all of us. But at that time, he was scared. He was a father, a husband, and a father of two. He'd tried investing in property before. He'd bought a couple of off-the-plan properties, and they'd failed. They'd lost a bunch of money. And as a father and as a husband, he was feeling like a failure. He was scared that he wasn't going to be able to be that provider for his family, to provide that security, to be able to help his family take the next step and to be able to really set them up for success. I remember he had $64,000 in savings, and that was it. And he was terrified. And I remember speaking to him, and he was sort of basically like, this is my last shot. And if I don't get this right, I'm not sure what I'm going to do next. And so he decided to work with us. Now, he may or may not have realized that he was our first client, but for most business owners, when they get their very first client, there's a celebratory moment. There's a story. If you ever read any kind of autobiographies of any kind of entrepreneurs, there's always this wonderful moment when it all became real. That didn't happen when this client started working with us. Not for me. Because in that moment, when he decided to put his faith in us, I realized that in that moment, he trusted us more than he trusted himself with his financial future and his family's financial future. Now, Gabby and I are good people. We want to do good work. We have great intentions. We always have had great intentions. But I suddenly realized that what if our best intentions weren't enough? What if we did our best work, we tried really hard, and we had our heart in the right place? But what if we got it wrong? What if we didn't? What if we helped our clients to make the wrong asset selections? And what if that put them behind, not ahead? And in that moment, I realized the real gravity of the situation that we were in, and really the real responsibility that we have as an organization. And from that moment, that really had guided the entire arc of how Dashdot has evolved as a company. Now, when we very first started Dashdot, we went to market as a buyer's agent. Now, why did we go to market as a buyer's agent? We didn't really know either. We didn't really know what a buyer's agent was. And in fact, before we started Dashdot, I had been hounding a mortgage broker because I just was trying to pick anyone who I knew anything about property. I was hounding them for knowledge. And this mortgage broker, who was very graciously giving me quite a lot of his time, one day said to me, because he could tell that I'd worked out quite a few things and I was sort of punching above my weight in terms of my knowledge. He said, "Hey, have you ever thought about becoming a buyer's agent?" And I was like, "What is a buyer's agent? I've never heard of that." Because 7 years ago, that was a really not a common thing. And he said, "Oh, dude, I mean, you can help people to buy properties and they'll pay you for it." And I was like, "What? You're joking. You mean I get to do the thing that I love and then people will pay us for it?" And then for Gabby and I, that became a wow, because we went through our own journey where we had bought property and failed. And we suddenly went, wow, imagine if we could help. I think it was 10 people, wasn't it, Gabby, in the first instance? Imagine if we could help 10 people. Yeah. Imagine if we could help 10 people make better property investment decisions. And imagine if they paid us for it. Man, we could make a living helping people. How awesome would that be? And so when we started Dashdot, we were like, we are Dashdot buyer's agents. Now, it's an interesting thing, the old buyer's agent nomenclature, because what actually is that? Well, a buyer's agent, by definition, is the inverse of a selling agent. And what is a selling agent? A selling agent will help you to sell a property. That's it. There's no expectation that they're going to be your lifelong partner in any way, shape, or form. They're there to create a transaction. They create the transaction, they go away till you're ready to maybe ask them to do another transaction at some point in the future. Job's a good one. And a buyer's agent is the inverse of that. It is someone who's going to go buy your property. And when we started Dashdot, that's what we were there to do as well. We were there to go and help people buy properties. Now, in principle, we had a desire to help people to apply knowledge and insights that we had to help people to try and outperform the market, to get better results, because we wanted to help them create financial freedom, because we wanted to empower everyday Australians to make informed, intelligent decisions so they could live more confident, more prosperous, and more fulfilling lives. We wanted people to make money and become financially free. Freedom, choice, and abundance. And so that was an additional layer on the let's go buy your house aspect. But fundamentally, that's sort of where we started. But over the course of the journey, and over actually a very short part of the journey, we realized that actually, if we really truly cared about our clients, really truly wanted to help people to achieve freedom, to actually not just go buy a house, there had to be more to it. We couldn't just be a buyer's agent. We couldn't just be someone who goes and buys houses for people. And so we really have invested over the last 6.5 years on developing ourselves to be much more than that, to be a holistic partners to our clients, because there's a lot more to becoming successful in property than just buying a good performing property. Now, to put that in context, and we'll come back to some of these ideas a little later, but to put that in context, you could buy the best performing property in Australia, but if you don't have a strategic plan that is going to allow you to leverage that property from 1 to 2 to 3 to 4 to 5 and so on, you will end up wealthier, but you will not end up financially free. You'll make money, but you still won't actually be able to retire early. And so the difference between buying a good property and building a successful property portfolio is immense. And one of the things that we have noticed recently in the market, and everybody else will have noticed it too, over the last 5-6 years, there's been a lot more buyer's agents coming into the market. And again, we don't at Dashdot, we don't consider ourselves to be buyer's agents. Yes, we do help our clients with the acquisition component of building a property portfolio, but that is just one piece, and we'll come back to that later. But there have been a lot more buyer's agent entrants into the market, which is great, which is absolutely no problem, and I think it's fantastic. And I would say that 99.999% of them mean really well. They are good people who want to do good work and want to help people. So I'm not here to try and deride buyer's agents, not by a long shot. The problem, though, that we have seen is that you can end up with an uninformed mass, a group of people who mean well, but follow each other into situations that create artificial stimulus, which can actually put clients into precarious positions. And that is actually something we want to talk about today. We want to talk about this idea that not all growth is the same. And so before I kind of continue on there, Sean, have you got anything you would like to add into that?
No, I think you've framed it up perfectly. It's a problem that problem's probably not the right word, but a pattern that we've started to see, and something that's only going to become more and more prevalent as everyday Australians sort of get more empowered to invest wherever they see fashionable, be it backed by data or not backed by data. There is that herd mentality. The power of the herd increasing rapidly. So it's something that you really have to be aware of when you're looking for a long-term plan, not just buying the best property in the latest hotspot. So yeah, I think it's a really important topic.
So, and there's another aspect to it as well, which is how the environment has evolved over the last few years. So if we go back to 2019, the idea, just the concept of borderless investing was a not common idea. Now, I'm not even going to for a moment suggest that we pioneered it. People were obviously doing it before Dashdot, but when we started Dashdot, we were really having to educate the market. Like, hey, did you know that you can buy properties outside your own backyard? Did you know that you can do? And to a lot of people, it was a foreign concept, because all you need to do is go back to, like, let's say go back to the year 2000. If you lived in Melbourne, how would you even know if there was a good place to invest in New South Wales? And then let's say you did get some hot tip that there was that Dubbo was the latest hotspot, for example. Let's say you lived in Melbourne. How would you even go about doing that? Right? Because you would probably have to pick up the landline phone and call a real estate agent, and then just like sight unseen, hey, can you mail me some photos? Like, I don't know, maybe you didn't even have any, like, how is that even going to work? And so what has happened even just over the last, say, 6 years is a significant evolution in capital movements through the market, facilitated by better technology, by more buyers agents in the market that are able to help facilitate more interstate transactions, all of this kind of stuff. And I think all of this is like broadly good, right? But necessarily it is a changing in the market dynamic, which means that capital flows are actually happening much more swiftly and more strongly in different directions at different times. Because whereas once upon a time, people would only or the majority of investors would continue to invest relatively local to them, maybe within a 2 hours drive of them, that would mean that capital wouldn't flow as aggressively throughout the entire national market. It would sort of rotate sort of in localized pockets, and then those localized pockets would go through their undulations and all of that kind of stuff. But you didn't have large capital movements shifting capital from one place to another very rapidly. In fact, it was pretty uncommon. In fact, I remember in 2016, 2017, if I've got my years correct, Norlane in Victoria was actually one of those first places where there was like a real, nationwide investor focus of people going, Norlane is the place to buy. And that place boomed. It went off. Gabby and I actually bought a property there in 2018 as well. But that was one of those first times where it was like, oh yeah, everyone, all the investors know that's the place to go. But now the difference between information dissemination and capital movements and facilitation of the capital movements around the country is meaning that the market dynamics are significantly shifting in such a way that it's creating greater oscillations and greater concentrations in the market. And that's doing a couple of things. Number one, it's shortening market cycles, I think, is one of those, and we can talk about that. But it's also creating the opportunity for markets to become overinflated too quickly without strong fundamentals. And Sean, do you want to kind of maybe should we start digging into that aspect of things first, like where markets can get inflated without strong fundamentals?
Yeah, 100%. I think the example you used with Dubbo is a really good one, because once upon a time, property markets were so isolated. Dubbo itself, if you to boil it right down, people investing in Dubbo were local business owners, mums and dads whose house had grown a bit. That was the entire investment demand for Dubbo. We're now on a journey whereby at some point, 100% of Australia's investment demand will be liquid as such to be able to move wherever it sees fit. So I think it's really important for us to understand that, because that's something that's fueling these. Do we launch the Babble term? BA Bubbles.
Go for it. Yeah, go for it. Yeah. Yeah.
But you just did.
I just did.
You did.
Sorry, Gabby. I stole your new term.
No, go for it.
Well, but that's like so. But this is like what we've been internally calling BA bubbles, and Gabby's put a bit of spin on that and called it a babble. We've actually been talking about that internally for some time, because we've noticed significant markets where prices are getting pushed far beyond what we believe constitute fair market value or fundamental kind of value propositions in a way, and it's being driven by irrational exuberance. Now, irrational exuberance is a dangerous part of the market to be in. You can definitely make money when there's irrational exuberance, but also you need to be very, very cautious about it. You need to know when to get in and you need to know when to get out. Now, we've seen this happen many, many, many times, because we have seen markets that we've gotten into our clients have seen exceptional growth. Their properties have doubled and even more than doubled. We've seen it as an opportunity to start thinking about exiting markets. And then we have then buyer's agents, less experienced buyer's agents. And by the way, also some buyer's agents that you would, I mean, if you used Facebook, if you're on Facebook, you would know some of these names, like 100%. Their clients are buying properties off our clients when our clients are selling them to exit the markets. Now, that is still going to drive some growth, right? That is still going to drive some growth, but you need to be very careful about what the shape of that growth looks like. And in fact, let me grab an example here to highlight what that is, right? Bear with me 1 second. Because one example of this is Gladstone back in 2012. Oh,
Perfect example.
Let me see if I can pick I hope I'm going to pick the right one. Let me see if I pick the right
one that goes up and down very aggressively.
Yeah. Okay, no, wrong tab. Sorry. It's very hard to pick the right tab.
Yeah.
Here we go.
Yeah,
I can just share the window.
I'll just quickly on these babbles as well. I think what's really interesting is that they're not, even within the term babbles, like these buyer's agent bubble locations, there's not one size fits all either. So like some of them completely artificial, like probably avoid if you can. Other ones, there's probably some fundamentals there, but it's going to like peak and drop off really quickly. So that's another version. So it's not necessarily like totally avoid them. It's just you need the right insights to be able to understand what's driving the growth in that location so you can make the right choices, right?
100%. I think, this is really a great opportunity as much as anything. It's causing a lot faster acceleration in markets. It's causing a shortening of cycles. So you can make a hell of a lot of money chasing these sort of bubbles, but it's just making sure that bubble effect is supported by underlying fundamentals, which we'll go through shortly.
Yeah, totally. So I just want to give this example here because this is actually like a really kind of famous and very important example. This is Gladstone, and it grew from 2001 to 2008, grew pretty well. And I actually think that the kind of like natural market top was around this level here, around the sort of 360-ish. You could see there was a little bit of an overshoot there and then a pullback. But then there was all of these, at the time, it wasn't buyer's agents, it was developers and all of this kind of stuff that were going hammer and tongs at selling and selling and selling and selling. It's the next big thing. It's the next big thing. And then we had this overextension, this overexuberance. This specific peak here was the irrational exuberance stage of the market that came in here. And a lot of people bought in this leg here, and then it crashed out, right? Now, I actually don't think that the crash would have been this deep if we didn't have this much of a peak. I actually think it would have normalized and gone through a shallower dip and then probably come across in a different shape. But this is the kind of thing that we need to be aware of when irrational exuberance kicks in. Now, the difference these days is how that irrational exuberance is coming to pass. And one of the challenges, I think, is with all of the media, everyone's podcasts and social media and stuff like that. It's very easy for people to get whipped into a frenzy. It's very easy for someone to say, look, hey, here's the latest, greatest thing. And then nobody else wants to miss out. And so you start to create an echo chamber, and that echo chamber becomes the fundamental analysis. And it's like, well, everyone else starts buying there, and therefore it's good. And one recent example of that.
Yeah,
and then
it's self-fulfilling at that point, because then it shows in the data, it starts to look hotter, days on market drops, supply drops, they're clearing out inventory, and it becomes this self-fulfilling spiral, which I think going back to that Gladstone example is an amazing example to use, because not only was it before all this tech and all the rest of it, but it was a media-led boom. There was this super project in Gladstone that was going to, I can't remember the precise numbers, but it was like 20,000 new jobs and this enormous project. So then the media started hyping it up that here's the spot to invest. Everyone piled in, and that's a story that we see in the media now, that here's the next big hotspot. I think that's a, ad copy used by virtually every BA in Australia. So it's a very similar pattern that we saw, and that was before the proliferation of this level of sort of liquidity and where the investment is directed.
Yeah, totally. And I think one of the locations where we can see that start happening to some degree is Darwin at the moment. Now, just to be clear, Darwin may represent a good opportunity for you to make money, right? But there's also a whole bunch of reasons where a whole bunch of things you need to be really cautious of with Darwin, in that it doesn't have a super strong set of fundamentals. Now, one of the things that we have seen, because we have access to a whole bunch of data that most people would not have access to, is we have seen a significant spike in what appears to be buyer's agent-driven demand. In fact, let me quickly share my screen again. So you can see here, am I sharing?
Yep.
Yeah. So you can see here from this chart here, for example, just look at Northern Territory. Now, Northern Territory is basically Darwin and desert, right? So don't worry about the fact that this is a whole state. You can see from this chart here, investor annual growth in loans by type. The investor loans have shot up by 123%. Now, what that is telling us is that is a significant amount of exogenous demand that's pouring into that market that is significantly out of balance with the rest of the market. So we can see that, okay, people have started the echo chamber that Darwin is good. Then buyers agents are going in there and buying properties for their interstate investor clients. Then that's driving up the price. That's driving up the demand to supply ratio. That's making it look even better. So then more people buy.
Increasing the frenzy. Yeah,
it increases the frenzy, right? It gets more blood in the water. More people start chasing chasing, and it starts to kind of build and build and build on itself. And you end up in a situation where prices are going up purely because people are trying to outbid each other to bid the price up. But if there's no fundamental endogenous demand in those locations, in fact, let me share a couple of. So let me share a couple more things, because there's probably a few other things here. And Sean, feel free to just jump in and talk over the top of me if you want to, if you want to get in there. So as you can see here, the investor loans, as we discussed, shooting through the roof. So that tells us that most of the demand in Darwin is being stimulated by investors, typically interstate investors. And you can see that what's happening there is the demand indicator is shooting through the roof. You can see this flying up here. And yes, supply is falling through the floor because there's less inventory on market, right? So you can see, and on face value, you might think that this is good, right? Except if you then start to critically think about, well, where is that demand coming from? Sean, you got anything to add?
I was just going to say, to be very clear, this is an excellent sign. And this is about where most people would stop. Supply to demand is breaking apart at a rapid rate. That's normally tick. Great spot to invest. But what we're suggesting here is that when you start to look deeper into where is that demand coming from, that's when you can start to sort of understand the fragility, or the kind of how supported that growth will be, or how supported those drivers are. If they're all from speculative interstate investors, they're obviously, I don't want to take us down the local relative affordability index again. I've said that a million times, but you can start to see.
But it's very important, though. It's very important.
Yeah, So that speculative investment demand, just boiling it right back again, if that's mums and dads from Sydney on massive incomes with huge amounts of money, you can quickly accelerate a market well beyond what would be relatively affordable for local people wanting to live in the area, which is where
Yeah.
we get this fragility and growth.
Yeah, 100%, 100%. And I think that that's actually one of the most important things to consider, right? Because at the end of the day, you've got, and we've talked about this plenty of times before. There's three, we have a very sophisticated real estate market intelligence, system that we use. But really, if you want to simplify it down to kind of three core ideas, it's jobs, lifestyle, and relative local affordability. And relative local affordability is a really key one. And in fact, I want to do an episode in a couple of weeks on why I think Sydney's had its last boom and will never really have another boom. And that's fundamentally because of the relative local affordability aspect. And when you've got a situation where, external investors, and I think I'm just looking up, I'm trying to get where
I had some numbers on it. I started digging a little bit deeper. And of the investor segment, this isn't loans-based data. This is demand-based data. So sales, 85% interstate. And there's even data, I haven't dug into where the data was sourced from, but that 80% of those were utilizing a buyer's agent within the transaction. So you can see it's vastly interstate speculative investment.
Yeah. And so if 85% of the demand is coming from interstate and 80% are using buyer's agents, that is then driving prices. So that means the local populace is not really changing. What is happening is you've got all these interstate buyers that are driving up prices, which then create a situation where the price to relative local affordability gets way out of whack and creates a very hollow market. Now, last best put something in the chat here. Chase the frenzy. It's super fun, but just get out before it all goes to the toilet.
It's a great point. It's a great point.
100% agree. Yeah, great. It's a totally great point. Absolutely, totally great point. The question is, you just got to know when to get out, right? And you've got to understand that you've got to understand what type of growth you've got. You need to understand what type of ride you're on. Are you on the scenic railway or are you on the loop-the-loop roller coaster? Which one are you choosing?
Yeah, and I'd also just challenge it slightly that you can also find places where this frenzy is in place and there is underlying fundamentals as well. Like to think of a really sort of common example over the last few years, we all knew that Perth went nuts, but even the Mandurah LGA, for example, yes, there was a BA frenzy. There was great yields. There was vacancies crashing, so yields were going to increase. Great cash flow, great affordability, and there was a BA frenzy driving prices up. However, it had a huge amount of government spending. It had enormous amount of jobs moving to the area. WA had, I'm fairly certain for the period that Mandurah was on the boil, had the highest internal migrations. That means the whole Australians were moving over there. There's a lot of fundamentals supporting that price growth from a point that was incredibly affordable to locals up to a level that was still affordable to locals. So what I'm saying is, you can have both, and that's a lot safer, a lot less risky, but it's certainly not the case that chasing these BA frenzies, you can't make money. You just have to understand what is driving that growth before you jump into a market like that.
Yeah, it's a really good point, because like fundamentally, there's not a problem if an area is in high demand. Like it's not like, oh, lots of people want to buy there, therefore it's bad, therefore it's a bubble. If there's good reason for it, but it's just a question of what is the underlying reason. Now you made an interesting point there around Mandurah and sort of Bunbury and those kind of areas are having a significant amount of interstate migration. The Northern Territory has had a net loss of migration in 2024. So there's more people moving out of the Northern Territory than more moving to the Northern Territory.
Yeah, and I was just going to say, and you can imagine that if they are already losing populace, what is an extreme increase in rents and prices going to do to that populace? It's not all of a sudden going to mean that half of New South Wales is going to go, yippee, let's go spend $600 a week or $700,000 to go live in Darwin. It actually, it's fuel on the fire for lots of these
for people to leave.
That can be pointed the wrong way. You want to have room in these underlying fundamentals, because as prices grow, quite often those fundamentals, the room in them can be eaten up.
Yeah, because what we'll actually find, so let's say that you have an exogenous demand boost that is not driven by fundamentals, i.e. there isn't significant jobs growth, there isn't significant inbound migration, all of that kind of stuff. But then you have a situation where you squeeze the property market, prices go up and become unaffordable, rents go up and become unaffordable, all of that kind of stuff. What happens then is you start to squeeze out the locals, and the locals start to say, well, you know what? I might like living in Darwin, which,
I
there's a certain
I
flavor
haven't
of it.
heard that before.
Well, people live there, right? So, they might like living in Darwin, but the value equation might change to the point where they go, you know what? At these prices, I might just go live somewhere else altogether. And so the local fundamental support of that starts to actually leave the location, and then when the investment demand drops out, when the last it's kind of like the greater fool theory. When the last person buys at the highest price and everything goes down from there, the floor is actually lower because the local
Yep.
populace has left because it got too expensive.
Yeah, if you pull up the Gladstone chart again, because I've just seen the question from Neutral Rockets, what happens when all these investors try to get out at the same time? You get what's called a doom loop, which is what we can see here in Gladstone, where all of a sudden, sorry, I'm talking to a graph that you guys can't see.
That's right.
All of a sudden,
Here we go.
people start selling, and that then is a self-fulfilling prophecy for more people to start selling. More people get scared,
Yeah.
and you can see the price floor in 2018 was dramatically lower than it was back over 2010 before the rush. So
yeah, exactly.
This is why this is such an important topic, because it happens quite quickly, and it's a self-fulfilling sort of doom loop once you get on the train on the way down.
Totally. It's a self-fulfilling prophecy on the way up, because more people are buying and more people are getting it. So it's almost like tulip mania on the way up. Because people are paying more, people will pay more, and that self-fulfills until it gets up to a certain point where it breaks. And then everyone tries to get out. And then because everyone's selling, everyone's discounting, everyone's just like, oh my God, I don't want to be the last sucker.
Get rid of it.
Everyone's just trying to get rid of it. And so it drives it down. So that's why I said at the start of this episode, I think the natural floor for Gladstone should have probably been around about this sort of 320-ish mark, where you see this level here,
you can see support
and this
over
level
there.
here. You can see some support here, and you can see some support here. The reason that it did this is because it did this. The reason that it crashed down to low to under 200 is because it spiked up to nearly around to 450 in a kind of exogenous fashion. And so, and it's these things that you need to be very careful about. Now, I want to just, can I change my screen? No, hang on a second. We're still trying to master the old,
It's the multitasking.
Yeah.
Well, there's so many options to share my screen in a certain way.
Okay.
I want to share a different example, because the same kind of thing happened with GameStop. Now, I'm not sure if you guys remember, but back in 2021, there was a video game store in the US that sold, it was like whatever, it was sold video games, and it was not doing very well. And then there was a whole bunch of, Wall Street banker types, investment banker types that was short selling it, i.e. betting that it was going to go bust. And then a whole bunch of people on the Wall Street Bets Reddit forum started saying, well, we're going to go crush these billionaires. And they started bidding it up. And the price, they just kept bidding it up, and then they're bidding it up. And then because the price was going up, more people saw that the price was going up. So more people piled in, and more people piled in, and more people piled in, and more people piled in. And it was a self-fulfilling prophecy. And it grew from, let me just grab my little, let me grab my little Duvalaki here. Let's take it from here. Actually, give me one sec. Oh no, what have I done? Oh my God. Sorry, guys. It grew by about 2,000%, about 1,800% in the space of like a month and a half, because people were just bidding the price up against themselves. Now, to be clear, if you had bought in here and then sold halfway up, you would have done very, very well, right? So if you had got on the train and got off the train, you could have made tens of millions of dollars. In fact, there are plenty of stories of people who did do that, or in fact, plenty of people who had booked $20, $30 million gains in that trade, but then didn't get out in time. And then in fact, let me just, reshare the screen again. They didn't get out in time. And then what happened is that it completely tanked. Now it tanked back all the way down to here. So the starting position was about $8 or something, or about $4, $5. Then it went up to about $87, and then it went back down to about $10. But then you can see that where it actually trended for some time was around about the $45 mark, right? But the whipsaw effect is because everyone's trying to get out of the trade in a very big way. And the same thing happens where people exit markets when they've overshot the market, is they'll then overshoot it on the way down as well. And that's where a lot of people can get hurt. So,
and I think in property, something to understand as well is that obviously shares. Everyone in there is a speculative investor in the share market. Property, the reason why this is even more important is owner-occupiers and people that live in an area have a certain level of stickiness, if we call it that. An owner-occupier that owns a home, Australia's done a wonderful job of creating so many taxes and costs to get in and out of homes that people are very sticky to their home. You've got to pay stamp duty to get in, agents to get out. You can't just buy and sell houses in your street, twice a minute like you can with stocks. There's a level of stickiness to it. And that's the support that we're talking about when you're assessing this, whereby speculative investors, yes, they can get in and out of markets as they make money, but it's the owner-occupiers that are the ones that stabilize the stock, if you'll have it, the same way that people holding onto stocks can level out this kind of whipsaw effect over speculative investors. So,
yeah, 100%. Now, typically, on average, it's about 33% investors in any market. That tends to be about the sort of market demand average. Darwin, interestingly enough, and I'm going to steal one of your data points here, Sean. Historically, owner-occupiers made up about 95% of buyers in Darwin. So 95% of Darwin's market has been made up of people who live there, owner-occupiers. At the moment, it's about 60% owner-occupiers and about 40% investors. Now, that is a very, very, very high ratio of investors for any market. Like typically, it's 30 to 33%. So 40% is pretty high. But when you consider that that's shifted from 95% owner-occupier to 40% investor to 60% owner-occupier, that is a significant change in the dynamic of that location. Now, that has a lot of second-order effects as well. Now, again, just to recap here, like people are going to make money in Darwin. The question is not the question is not has Darwin grown or will Darwin grow or any of that kind of stuff. The question is, on what basis are you choosing that growth? And is that based on sound fundamentals? And do you know what you're in for? Now, I'll give an example. So Gabby and I bought a property in a very remote mining town several years ago because we could see in the data that it was going to pop. Like I was like, this is like 100% guaranteed that this is going to pop. And I also know that it's going to go up and then it's going to go down. But it was very cheap property that we bought. And I was like, hey, Gabby, do you want to just take this one for a little spin? And it did exactly what I thought. But we knew going into it that it was not a long-term hold. We knew that it was short-term fundamental. It was short-term drivers that were going to make it pop and then go down. We did well on that property. We bought it for like 180 grand. And I don't know, we sold it for, I don't know, whatever, nearly twice that, right? So we did well on it, but we knew that it was a short-term trade. And if you don't know that it's a short-term trade, then you could be caught short. And if you don't have the right team around you that is going to be able to monitor those locations, and this is where the issue comes in with sort of the traditional buyer's agent model, is their job is to help you to acquire a property. That's it. It's their job's to help you to acquire a property, and to be there when you want to buy another property, and that's great. It's no problem. Like we're not here to shit can buyer's agents, right? But that is fundamentally a buyer's agent job, is to just go buy your house. Unless you have a team that is also going to help you to monitor when to exit the market, then you could find yourself in a really tricky position, because you may go up in, you may get 100% growth, but then if you don't get out at the right time, you can end up going negative by 20 or 30%, and you can end up in the hole. And that's happened to a lot of people. And then you're left holding a dead asset that's underwater or selling at a loss. And neither of those two things are good. And it's really just an aspect of timing. And so you need to know what type of growth you're getting into and what are the drivers. I'll use another example here that's a little bit of a different one as well. There's another town called Morwell in Latrobe Valley, which I know quite well because I grew up near there. Now I've seen a lot of talk recently about it being the latest hotspot because the yields are so high. And that seems to be the sort of fundamental conversation. Oh, the yields are high. You should definitely buy there because high yields mean that the prices are going to go up, right?
And high yields draw buyer's agents is normally the way that it happens too. The yield hounds come in and start the frenzy.
Yeah.
Well, this is right, and this is because look, anyone who has been following our work for the last few years knows that for the longest time, our catch cry was cash flow positive properties in high growth areas. Right now, the problem is most buyers agents or most people out there are not willing to confront the brutal fact that yields are compressing and will continue to compress into the future, and cash flow is not what it used to be. And to make intelligent investment decisions, you need to look beyond just yields. And so, I look at a town like Morwell, which I know because I grew up in the area. My parents still live in the area. It is a dying town. It is a dying town. There is not a lot going for it. It is my grandma used to live there. It started to die when my grandma was living there. I watched it go from a thriving town to a dying town, and it has been dying ever since. And it's continued to die and die and die further. It is not good. The reason the yields are high there is because it is a dying town. It's because, right? It is. And so the higher yields are not a signal. They're not a positive signal. They're a negative signal. Right. And so, days on market has been shooting up, but yields have been shooting up, and people are saying, okay, great, let's get in there because it's cheap. Because the market is cheap and the yields are high. Therefore, it must be good. And I've seen the same rationale around Darwin. Oh, relative affordability, which they're measuring in the wrong way because they're not measuring in relative local affordability. They're measuring it off national affordability. They're saying, hey, look, it's a cheap market and the yields are high, therefore we should buy there. And that's just not a sound rationale for buying a property, buying in any location. And so you really need to understand what are the fundamental drivers, and how would you actually understand why you're buying in a location, and how would you do that for yourself? And Charlie, I'll answer a couple of questions in here because
he's onto it. Yeah, and it's true, Charlie. There's been 3 major mine and power center closes in that area, which is precisely why it's dying and why the yields are high. So you're onto it.
Yeah, totally. Right. So the same situation with Churchill, and same situation with Churchill is a little bit different because of the university, but that's very spurious at best. Then Moe Newborough, the same situation. Yeah, so all the coal power, all the coal mining stuff has been closing down. Morwell started to die when the Hazelwood power plant was announced that it was going to close down, and then there's been more mining closures as well. What's happening in the Latrobe Valley is economic concentration into Traralgon specifically. So all of the kind of like GDP of the area, or all of the economic value of the area, is concentrating into Traralgon. And what's happening is in the satellite towns around Traralgon and the rest of the Latrobe Valley, yields are rising up because people are pulling out of those locations, right? And so yields are rents versus property prices, right? So basically just driving yields up, and everyone is accreting into Traralgon, and Traralgon is actually becoming a self-sustaining economy. So that's actually stable in that area, but the rest of the market's not good. So you really need to be mindful of these things.
Yeah, can I just double click on the yield conversation, because I think it's really interesting. Obviously, people coming through wanting to invest in property, and they have this concept of like must be cash flow positive. And as we're experiencing, and we've talked about numerous times over the last couple of weeks, Goose, we need to be nimble, and we need to be adjusting our strategy for the realities of the market, right? Interest rates are through the roof. They might continue to come down slightly, but still the yields are still compressing over time. And to the degree that there's a conversation about whether chasing yields is the right thing for an investor anyway, but potentially even if that is your approach, it's like maybe this isn't the right asset class. Like our belief being Australian real estate is still the strongest asset class on a risk return basis.
Yeah.
But if you are so hell bent on like must be cash flow positive, must be spinning out cash flow, reality is it may not be the right asset class.
And I think that'd be red flag number 1. If you were going to a BA and you said, hey, I want cash flow, or I want 6% or whatever it is, and they said, yep, great, Darwin's your spot, then that's precisely what we're talking about here, that is fueling these babbles.
Yeah.
So it's something to be really careful of, and something, again, like I think it would be good to leave people with sort of how to identify when you are in a babble, or how to know when to get out. But let's say you do want to be a GameStop millionaire. You want to pick a babble, you want to ride the wave, you want to get out at the right time. So there's certain things that you can sort of watch firstly to forward predict a babble, which is things like yields that are already exciting, vacancies dropping, people moving to the area, the likelihood that rents will go up and yields will increase. That will draw buyers agents to the area. Now, again, I'll be really clear. This is for a babble. This is underlying fundamentals. But then as you're riding on the way up, something to keep a really close eye on which again, this is something that we keep an eye on for our clients. But just if you have bought in a Babble or you're doing this yourself, keep an eye on volume of rental listings on the market. As investors pour in and buy investment properties, that increases the number of rental listings available on the market. You don't want vacancies take a little bit longer to level out, but you want to watch how much stock is going onto the rental market for starters. You want to watch the investment lending percentage. So we had that graph up before. How many loans are getting written in these areas that are investors? Is that shooting up? And again, you want to watch the trends, not the numbers. Is that shooting up, or is that finally starting to slow down? Because that's the point where you really start to get concerned. So if that growth slows, that's something that you'd want to watch. And probably the last point is that a lot of people think days on market increasing is a great thing to watch. Like, wait for days on market to be increasing. So something that I'd be watching is a slowing of the acceleration of the dropping of days on market. So I'll break that down a little bit more. Days on market will start to drop. Now, be wary because days on market's a rear-facing metric. So again, you'd rather be 6 months too early than 1 minute too late in these Babbles. So it's really important to understand the trends. Days on market won't register until properties settle. So what you'll see in these Babbles is days on markets will start to take a dive. What you want to watch is when the rate at which it's going down starts to slow. You don't want to wait for it to be going up because then you're in that doom loop that we saw Gladstone 2013. So there are three things that if you do own a property that you might think is in a Babble that I would be keeping an eye on. There's a number of other ones, but they're all readily available data that you can find on ABS and things like that.
Yeah. And so one of the ones that I really love that you pointed out there was the volume of rental listings, right? And so typically, specifically, you want to look at the relationship between new rental listings and volume of rental listings, right? Because if you see that there's, let's say there's, I'm just going to pick a number here. Let's say that there's 20 new rental listings coming onto the market each month, right? And let's say that's stable, but the total volume of rental listings on the market is increasing. That tells you that there's an oversupply, right? And so that is going to lead more than vacancy rates will lead, right? And so looking into these things is really super important to understand. So I think that's some great tips, Sean. So
yeah, and to Charlie's point, yes, if you are incredibly educated and or you have somebody on your team that is watching all these things that I've just mentioned, things, that definitely wasn't an exhaustive list. But yes, there is examples where getting in front of BAs like that is or you can make a lot of money. But I'd probably challenge it to say, rather than getting in front of miseducated BAs, maybe get in front of educated BAs to get the double whammy. Again, get the BA frenzy, but also get the underlying fundamentals. So again, I'm not saying that you cannot make money, but yeah, it's important to get.
And Charlie, you've been on the benefit of that. You know, like you got into Bundaberg early because we helped with that, and then the rest of the frenzy came. And they're still flogging it like a dead horse, right? And that is an example of getting in early and front running the buyers agents, right? But you also just want to make sure. So there's sort of like two categories. You've got educated buyers agents that tend to get in too late, and then you've got uneducated buyers agents who tend to pump up markets that shouldn't be getting pumped up. And there's the sort of, you know, and could you get into those markets? Could you identify? Yeah, there's definitely strategies where you could identify where all of the uneducated buyers agents are starting to race towards, but the question you've got to ask yourself is like, how much cortisol do you want in your life? How much adrenaline do you really, really want? Given that property is quite illiquid, it takes time to buy and it takes time to sell. And to your point, Sean, it's better to be 6 months too early than a minute too late in these kind of situations, right? And so you've really got to be on top of it to make sure that because it's quite speculative, right? And so to your kind of question earlier, Charlie, what percentage? I'm not going to comment on that last point there, but what percentage of your portfolio is appropriate for speculative bets? I think everyone is going to be different, right? And it really depends on the size of your portfolio, because if you've only got one investment property, probably 0%, right? Like probably 0%. Don't be out there just trying to like go, okay, I've got one, so now what I'll do is I'll go and speculate. But broadly, in a kind of more generalized sense, as I think about an investment portfolio holistically, 10%, something like that. You know, like if I think about other liquid investments that we've got, we would have 10% of our liquid investments in stuff where we're like, all right, cool, let's have a punt. Like we think this is a really interesting idea. And so I think you've really got to be, it really depends on where you're at, because different investors go through different stages, and at different stages, what's important changes. So you tend to go through this kind of, in the early stage, you need to be aggressive, but not speculative, because you need to grow. Then you go through a phase where you want to sort of consolidate and stabilize. And then you get to a place where you've got enough surplus that you can start to speculate, right? You sort of go through this like aggressive, conservative, and then aggressive again, if that makes sense. It's sort of the three legs of the investor psychology. So I think for someone who's got a very advanced portfolio, is it okay to have a crack at something that is cheap that you think could go up, but you're okay if it kind of doesn't, and maybe you lose 10 or 20 or 30 grand, and that's not really going to bother you too much? Totally fine. No problem. All good. But don't make that your investment strategy, because that is going to end up bad. And Gabby, I just wanted to double click on a point you were making earlier around like chasing yields and all of that kind of stuff. And I think that there's some real interesting analogies to sort of like stock market investing. So value investors fundamentally have not performed as well as growth investors over the last couple of decades, and that is because they spend a lot of time analyzing PE ratios. Now, PE ratios, you could just use that as a proxy for yields, right? What is the earnings versus the price, basically, right? Effectively, right?
Yep.
And so what has happened because of monetary inflation is you have a distortion of the price, but not the earnings. The earnings doesn't go up. The earnings doesn't go up as fast as the price does. And so what's happening is, if you look at the stock market today and you look at what sort of Warren Buffett's acolytes, they'll all be like, oh, everything's overvalued. PE ratios are through the moon, and all of that kind of stuff. And it doesn't make sense. And that's because the numerator and the denominator are changing. They're becoming disconnected from each other, right? So earnings aren't changing as much as prices are. And the reason prices are changing is because in nominal terms, because of monetary inflation, prices are going up. So necessarily, because the asset prices are going up faster than the earnings can increase, you're going to see a collapse in that. And that is why most and so understanding that is going to help you to shape your investment journey. Because if the only way that you can make sense of buying something is on a value invest, look, I think about value investing as value relative to its actual kind of market value, but value investing in a more traditional sense is kind of earnings versus price in that sense. If you're constantly stuck in this paradigm of yields have to be X, or it has to be cash flow positive, or it has to be something or other, then you're going to get left behind. Like, that's just the simplest way to think about it. There's this great story that I heard recently about there's a guy named Anthony Scaramucci. You can look him up. He's an investor in the US. In 1999, he was at this investment conference, and Jeff Bezos did a presentation, and Jeff Bezos was talking about Amazon, and had this amazing presentation about Amazon and how they're gonna expand it to become this everything store. But the reason they chose books is because books are almost uniformly the same size, and they can use that to dot plot out where all the warehouses need to be and get their logistics plan, and all, like, this whole master plan of like how Amazon was going to take over the world and all of this kind of stuff. And Anthony Scaramucci's taken pages of notes, and he's like, oh my God, this is freaking awesome. And he's like, oh my God, this is the best. I'm going to go buy Amazon. And then literally the next speaker was Warren Buffett. And Warren Buffett came on the stage and he was like, oh, Jeff Bezos, what a lovely young man, what a great guy. But can you believe that Amazon is worth more than Sears Roebuck? Sears Roebuck was a big kind of like, kind of department store chain at the time, which was very big and famous. And he's like, Sears Roebuck, you see it on every street. It's this big name, all this kind of stuff. Can you believe Amazon's worth more than Sears Roebuck? It doesn't make sense. And it did a whole presentation on why that didn't make any sense. You needed to be a value investor. And Sears Roebuck is now bankrupt, and Amazon is one of the most valuable companies in the world. Right. And at that time, if Anthony Scaramucci, and this is the punchline of the story, if he'd invested $10,000 in Amazon at that time, it would have been worth $15 or $16 million today. And so the whole idea here is that you need to be able to adapt your strategy to the situation that you're in, not try and just focus, not try and stay static in these environments. So we've got a little bit off topic on the Babbles.
I think that's really interesting though, because it's like you need to almost let go. You need to acknowledge the beliefs that you hold about investing generally, like not just genuinely. You will hold some sense of belief about what a good investment is or what I should be looking for. And I think at the end of the day, you need to like strip all of that back and just be realistic about the current situation, like the current macro environment, micro environment, the locations that you're in, what you're trying to achieve, your financial situation, and actually just take stock of that in reality without all of your bullshit beliefs about what is possible or not possible and how you should approach that strategy. It's like stripping all of it back is really necessary if you're going to like make the right move.
Yeah, and to understand what's changing, like these Babbles that we're talking about. So, because I think we have in a way sort of painted Babbles quite negatively here, but I think it's really important again, because I can see stuff in the chat about speculation or not speculation, that we make clear that Babbles are not necessarily a bad thing. I keep thinking of the old El Paso ad where they throw the girl in the air and say, "Why don't you have both?" You can definitely have both. That's what you that's what you want. And a great example again, we were talking up above about following misguided or miseducated BA's bets. Townsville's a great example where it required a very low level of education and understanding to realize that was a great play. So it doesn't necessarily have to be this crazy finessed, we bought in Townsville, a lot of people bought in Townsville, and it was a great move. And that is another great example where, yes, there is speculative investment-led demand, but there is all the underlying fundamentals and it is still a good play. So it doesn't necessarily have to be, am I going to speculate or am I not going to speculate? Every investment bet is a speculation. So we're not necessarily saying Babbles bad, Babbles are good, but you need to understand what they are, how they're happening, what to watch out for so that you don't get stuck on the way down.
That's why I think it goes back to like understanding what type of growth you're getting yourself in for. Like it's all well and good to buy, but you got to understand what type of growth you're getting yourself in for. And now, once upon a time, because there was a lack of information, lack of systems, lack of support, lack of teams, lack of process, the effective method for buying property in Australia, investing in property in Australia, was to just buy property and wait. And that was it. It was like, right, just find a decent property, make sure it's got good bones, and just buy a property and wait 30 years. And that's it. And I think that the thing that's changed, just in the same way that your strategy needs to change, your optics need to change, you need to become more aware of like, why am I buying in this location? Like, what is this? Is this a sugar hit? Is this a long term? Is this a short term? How is this going to support my portfolio? You need to actually also have a system. And, that's why we have developed what we call a portfolio growth system, which is a combination of planning, financing, acquiring, and optimizing. And I think it's the combination of, certainly from our point of view, it's this combination that is actually what you need in order to be able to be successful. Because to Sean's point, you can absolutely buy in a short-term growth location as long as that is part of a strategically well thought out idea. Right? You absolutely can do that.
And you or your partner with is watching what you need to be watching. That's the key point here, is that we're trying to illustrate that it's not this buy, hold on to it for 20 years. That optimized section, which I can speak from experience. I'm reviewing the suburbs that our clients that have bought 3-4 years ago are in. I'm reviewing them constantly. That's the key piece that we're talking about here, that you are watching these things so that you can avoid being caught in a Gladstone 2014.
Totally. And for most people, what they're getting when they're working with a buyer's agent is this: they're just going to get the acquire section. Let's go buy a property, right? And essentially, they may be in a location where they believe that there's going to be greater than average growth or something like that, but it's fundamentally that. But the reality is, you need all four parts of the system to work together if you want to be successful. You need to have a clearly defined plan of how you're going to get from where you are now to where you want to be, where you want to be. You need to be able to finance that. You need to have a finance strategy that's going to complement your strategic plan to make sure you can actually acquire the right properties in the right order, in the right sequence, and not run out of borrowing capacity. Then you need to make sure you're acquiring the right property in the right place at the right time. And then, to your point, Sean, you need a team around you that's going to continue to help you to optimize your portfolio, not just leave you to it to work it out. Now, I can talk from personal experience with this, or Gabby and I can talk from personal experience with this. The property, or one of our properties, a couple of years ago, it was worth $650 according to the bank valuations. Then we went to sell it like a year later, and the market value at the time was $410. And because we just missed it, we were like, oh yeah, we were kind of like, we just weren't paying attention to it. We just weren't paying attention to it. And because we weren't paying attention to it ourselves, and this is before we'd built the optimized section in the portfolio growth system, because we weren't paying attention to it, we missed it. And then it was like, okay, well now it's not worth selling. We'll just wait. And we're going to have to wait a few years for it to grow now. And that's what you want to avoid. You want to make sure that you've got a clearly well-structured system that's going to help you to work like a flywheel to continue to grow and grow and grow rather than stagnating and getting stuck.
Yeah. And to
Yeah.
Charlie's point in the comment here, yes, this will get bigger, will get more frequent, and that's where the opportunity lies. I feel that people that can master this and understand that market cycles are shortening, growth is getting more rapid when these markets come on, and the people that can master this, the opportunity is so much greater. Like the example we're giving at the start of the podcast on Dubbo, just sitting there, you might have got 5 to 7% for 20 years and hold on to it for 20 years. It's not the case anymore. So the people that can master this flywheel, get in 80% growth, 100% growth, get out, move it to the next market, and understand what's driving this kind of movement and shortening of cycles. That's where the opportunity lies.
Yeah. And to expand on that too, because this is accelerating, because we're seeing more capital movement and we're seeing cycle shortening, we'll see faster growth and more growth, and we'll see yields collapsing and faster rotation. So your ability to understand these markets and how they're moving and how to rotate capital is going to be the difference between you growing your portfolio or not growing your portfolio. Because what will happen is you'll be able to grow capital in a certain market, exit that market, rotate capital, change your, lower your LVRs, support cash flows, do all of these kind of things with a sophisticated finance strategy that's going to be able to utilize all of that capital that you're accumulating in the markets and redistributing through your portfolio. So yes, the short answer is yes, we are going to see more excited markets. I think a few episodes ago, I talked about it like popcorn in a frying pan. We're going to see like a rolling boom of like markets popping up popping all over the place. It's shortening of cycles. So we're going to see a continued collapse of yields. Sean, do you remember a few years ago, we were buying properties that were like 7, 8, 9% yields?
I was one of those yield hounds. I was chasing the yield.
You were a yield hound, yeah.
It's crazy.
Still am.
I know, but I remember buying properties that were 9% yield and stuff like that.
Yeah.
It's crazy. Like it was wild. But now, on average, what's our average yield that we're buying at the moment? It's like what, 4.7 or something.
Yeah, I'm not sure, but it would be more likely, down in the 4s. And that is the reason, or one of the reasons why this is intensifying. People are clinging to that little bit of cash flow that's left, and that's why they're making subpar decisions to move into markets that are missing the main fundamental that you're after. Most people, at early stages in their portfolio, you need growth. You need as aggressive growth as you possibly can to get a large capital base ahead of you. So if you're sacrificing that to go and cling on to the last 0.3% yield higher in Darwin or Humpty Doo or wherever it is, that's why this is intensifying, is that kind of yield. I won't call it yield hounding, but the yield, people clinging to those last remaining pieces of yield spread across the country.
Yeah, but if that's the only fundamental reason you're buying in a location is because of yield, what that'll do is that'll artificially inflate the price, and there'll be nothing to catch it on the way down because you're going to hollow out the market. And so it's the wrong reason to get into a market. I say to people all the time, like, hey, if you want me to find your cash flow positive property, no worries. I can do it in about 5 minutes on realestate.com. No problem. Like easy. It doesn't mean it's going to be a good investment. Like, it's not, doesn't make it a good idea. So anyway, do you think we've covered enough good stuff in this episode, Gabby? What do you think?
Yeah, we have. I just wanted to, I don't know if you could bring back up the portfolio growth system, Goose, for me.
Back up, yeah.
Just because you've got it in front of you somewhere. I wanted to bring it back to how you started this episode talking about like how we ended up creating this, because I think obviously when we started this business, as you said, we started as a buyer's agency, right? So we did just focus on the acquire phase. But the reality is these ones that are blocked out now, plan, finance, and optimize, there's still things that investors need to do, but it's just that you're trying to do it on your own. And most people don't have the skills or abilities to know that, let alone the time. Like a big reason, clients come and work with us is the time saving, let alone the expertise. But these things still need to happen. Like you still need to figure out how you're going to finance things. You still need to optimize and monitor the performance and make adjustments. You still should have a plan. A lot of the time, if you don't have a plan, that's when things go really wrong because you haven't been strategic about what you're actually buying. You're just kind of collecting properties. So all of these things are still things that you need to be doing, and people are still doing it, but you're doing it on your own. And as a business, this has been the development of our business. We started with just doing the acquire section, but over time, like we are really motivated by genuinely getting people to their financial goals, because I don't care if you're just collecting properties, this market booms, great, and you're collecting these assets if you're not actually moving closer to your financial goals. And so every development that we've had in this business has been adding to this system. We've been building this business and this system for 6 years now, more than 6 years. to add in these services and expertise and dialing it in over those 6 years, so that we have this whole flywheel, so that you can just plug in and go around it, and we help you through the whole thing, so that someone can come in with like no idea of what they want to achieve. They have like this rough goal of like, in 10 years I want to retire or something. We help them to define that, and we help them to acquire the right assets and then monitor them and help them to exit as well, so that the whole machine just keeps flying and getting them closer. So that's kind of just how we've gotten to this point. I'm personally, I'm really proud of this system we've created. And I think it's, as we're talking about the changes in the market, it's becoming more and more necessary, all of these different pieces, because it's less easy to go out and just buy an asset that's got 9% yield, or like something that's going to boom because of, pandemic boom, and like all of these like quick wins that maybe didn't have the fundamentals that got a lot of people growth or good cash flow. Those are few and far between now. So it's like this system is becoming more and more necessary.
Yeah, totally. And I think it's a really good point that you don't want to be a property collector, right? You
No.
want to achieve financial freedom, not be a property collector. It's not about collecting the highest number of properties. Some people still have this like kind of broken idea
they're
of
a
like,
headache.
well, I need to it's like I speak to people all the time, and they're like, oh, my goal is to buy 10 properties, or my goal is to buy 15 properties. I'm like, no, I doubt it.
Yeah, why?
I doubt it. I bet your actual goal is to not have to work in the next 10 years or something like that, right? So break it down. It's like, it really doesn't matter how many properties you own. It's like owning the right ones. I often say to people that you need three things. Well, four things to be successful in property. You need a robust and sophisticated plan. You need robust and three core things. You need a robust and sophisticated strategy. You need a robust and sophisticated execution. And then you need a robust and sophisticated team to be able to support you along the way. And those three things working in concert kind of cover all the bases of the portfolio growth system. But having those things together is what's going to, because if you have a great plan and poor execution, doesn't really matter. If you have great execution and no plan, doesn't really matter. If you have a great team and all that kind of stuff doesn't matter. But you need all three of those things working together: a robust and sophisticated plan, robust and sophisticated execution, and a robust and sophisticated team. If you have those three things working together, along with the portfolio growth system of plan, finance, acquire, and optimize, you will become successful. It won't be about the number of properties you own. It'll be about the degree of success you obtain. And that's really the metric. It's like, how do you get to your goal sooner? And Gabby, I want to do a whole episode on retiring earlier, because I think people have got like a really misguided perspective on retiring. They and this is a topic for another day, but they talk about wanting to retire by 65, but most people's health span finishes at about 65. So they want to retire just as they start to get sick. It doesn't make any sense. So you really want to have a plan that's going to accelerate you and not take the slow road. You want to take the fast and safe road, but you can only do that if you've got a robust and sophisticated strategy, a robust and sophisticated execution, and a robust and sophisticated team. So cool.
All
right. Great. Anything else we want to cover off before we wrap things up? Okay. Do we think that we've successfully helped our listeners and watchers and the community that we've got here, by the way, it's awesome to see so many guys here, so many people here. Do we think we've successfully covered off understanding that there's different types of growth? You need to understand what type of growth you're getting into, some of the things to look out for to make sure that you don't get caught flat-footed if you are in a Babble. Do we think we've successfully communicated everything we need to communicate to the community?
I think so. I think Sean, you had a section in the middle where it was really practical about like things to look out for to make sure, like, check if you are in a Babble or not in a Babble, and keeping those things in mind. I think that was really helpful as well. Again, like we've been saying, this is not bashing buyer's agents, because most buyer's agents are totally amazing, good-hearted people, and they're doing the best. But a lot of the time, like Charlie had a comment about like YouTube channels, a lot of the time that's the best research that people have available. And it's been more prolific in the last 10 years as social media has just completely boomed, that people, this is marketing strategies for people, and they just want to like come across as a thought leader. And so they put this out there, and then another buyer's agent sees it and they hear that, and it's this self-fulfilling thing as well. And so it's not them, there's no bad intentions there of trying to get people into like the wrong locations. Everyone's doing the best they can with the tools they have. But a lot of the time in the moment, it's not actually going to get you the right results.
Yeah, 100%.
Agreed.
100%. All right. Well, we
Cool.
need to leave it there because the fever's taking hold and I need to go lay down, I think. So that's enough
Oh,
for today.
no. Awesome.
You did well.
Awesome. We did. We got there.
Sean,
We
thanks
made
so
it.
much.
Thanks,
No worries.
Sean. Great to see everyone. Next week, we've got a juicy episode that we're going to cover next week. I'm really excited about it. We've got a bunch of really interesting stuff coming up in the next couple of weeks and I know that because I keep thinking of all these really sick topics that I want to talk about, and then we're going to be talking about it.
Sick. So sick.
Yeah. Next week we're going to be talking about the prosperity wave, which is a thesis that I've been developing around what happens beyond 2030. So what happens on the other side of the kind of AI, inflation, all that kind of stuff. Where do we go as a society? How does that play out? So next week we'll be talking about the prosperity wave. The week after that, maybe I think I want to talk about retiring earlier than you think, because I think people are trying to retire too late. And next week as well, we have a very special announcement that we are going to be launching something for the community. So make sure you join us next week so you can get first access to that. It is free, but you're going to get it first if you join us live on the episode next week. So that's it for now.
Nice.
Thanks, guys. Great to see you. See you next week. Bye for now.
Bye.